Greetings, everybody. This is Jeff Scott, and this is my review for October 20th, 2019. Just as an FYI, I am doing this in Myrtle Beach, where I'm attending the Mark Minervini Mastering Trading course, and I forgot to bring a 1080p computer, so I'm doing this in 4K. So even though it's only about 9:30 on Saturday, probably won't get up until tomorrow. It's going to take forever to upload. For those that hate the quality of the video, this was my first attempt to see what 4K looks like. If, on the other hand, it seems to go well, there's advantages to me, I'll continue to do 4K. If you're watching this on YouTube and the quality is horrible, I would suggest you download it from one of the sites that will be in the email as well. So I titled today, Chopping Your Old Highs. Eventually, if the market doesn't go down, it probably goes up, and we just seem to be bouncing away around just below those highs, so we'll see. I think we have some interesting things going on in the market. Let's talk about them. As always, it's for education purposes only. I'm a doctor, not a broker. I'm independent. I pay for all the tools that I have, and trading involves risk, and you alone are solely responsible for any investment decisions you make. Those who've been to my live meetings know what my philosophy of trading is. You have to make your own decisions. Are you stocks or are you futures? Are you day trader, swing trader? Do you hold through pullbacks, and are you a longer-term position trader? Clearly, I am a swing to position, and I believe that the longer I hold them, the easier it is to trade. But I do have to weather some drawdowns rather. Some people are not comfortable with that, and I understand. I tried day trading, too much work. Swing trading is great, and so I start with swings, and it's not unusual for me to change my perspective to a longer term on some of these stocks that I have had some great success with. I also believe that you need to learn from masters, from smart people. That's why I paid $5,000 plus airfare, hotel, and food to come to this meeting with Mark Minervini, who, like others that I listen to, has a background in canceling. Ryan here is here. I can't remember what his first name is. Also a world-class trader, and previously was a money manager for O'Neill. I started with CanSlim. You see the books here at the left, and it's been improved by many people. It's been improved by Ian Woodward, who was sort of the impetus behind HGSI, certainly improved by Morales and Catcher, improved again by Mark Minervini. And in addition to that, I've learned position size money management from Van Tharp, how to actually trade once I've decided what I want to buy and when I want to trade it by John Person. Sager down here with Superior Profit has some great tools that I use. And then I will be doing a live event on, I believe it's Saturday, November 2nd. Let me check that date. I wasn't going to do anything this year. Pause this for a second. Sorry about that. I'm speaking at a program November 2nd, 3rd, and 4th in Las Vegas. The program, I think, runs through the 5th. But I have to fly back to Florida from Las Vegas on the 4th. So on the 6th, I can take my wife out to San Diego to go to a country concert. And I promised her I'd come home to get her first. In addition, John Person has his meeting in South Florida. I believe it starts the 30th and 31st of October and November 1st. Maybe it's 31st, 1st, and the 2nd. And I'll probably have a cameo appearance there as well. If you have questions about John's event, go to www.personsplanet.com. Any questions about my event, just email me at hgsidoc@gmail.com. It's really George Lee's event. He's just an awesome guy and great trader and great teacher, and I look forward just to sit in the audience as well as speaking. I take all that I learned from the masters and I create my own style, and I say, be your own guru. Don't rely just upon others. All right, back to the story. I have a lot of software. TradeStation, Thinkorswim are my mainstays. HGSI is where I do my analytics. I do some seasonality. I've listed some of the websites. Just call out stockmarketmentor.com. Dan Fitzpatrick, he's actually at this event. And I had a nice dinner with him tonight and had some good discussion I think he just does a great presentation. He does movies every night, several on the weekend, and he looks at the market very similar to what I do. So I told him, and I look at him as kind of a co-pilot in that it's always nice to hear what somebody else thinks in a non-threatening way. So I listen to his videos every night after I make my own decisions. I learn a lot from him. Highly recommend it. He has free trials like most people do. Speaking of free trials, this is the website for HGSI. I'm independent, have no financial relationship, but if you click on free 30-day trial, you'll get, as it says, a free trial without a credit card. More importantly to me, if you click on investing strategies, you'll see hundreds of videos by me and others, free for download, even without registering. Stock patterns are cyclical. I want to be long during stage 2. I want to be short during stage 4. And during periods of uncertainty, whether it's stage 1 or stage 3, 1 being a transition between fear and greed, and stage 3 is also that transition, but sometimes it doesn't exactly go the way you expect. I raise cash in stage 1 and stage 3, have smaller and less positions, and wait for the market to declare itself. We are clearly in a stage 3. Every time it looks like we're going higher, we pull back. Every time it looks like we're dropping, we pull back, we retrace. So at this point, we could certainly go either way, and therefore, I'm a little bit more defensive. And I do a lot of look at a lot of market indicators to give me a sense of which way the market's going and to help me there. And I also adjust my trading. I won't spend much time on this, but I do differently in the different stages. End of Friday, for indexes that were down significantly, look at how much green was there. Real estate, popping. Financials, popping. Interest rates actually were pretty steady this week. Technology, not popping. So there's a mixed market when you look at from a bottoms up. But as you know, the major indexes were down quite a bit. If we look at the major markets, this is from Thinkorswim. Upper left is the E-minis, middle is the NASDAQ futures, the Dow futures. Down the lower bottom is IWM, Russell ETF, the VIX, and the dollar. The white boxes that open up are the highest high while we're sitting within the period of time on the charts. The low is the lowest on the chart. And you could see from the December lows, we've had significant runs. And the highs were reached earlier this year, more recently on the NASDAQ and the E-minis, a little bit earlier, actually a couple months earlier on the Dow. And we really haven't set a new high this year, an all-time high on the Russell. But what you also notice is we're above the 200 on the 3 major ones. We're below it on the ETF for the Russell. And we're much closer to the highs of the year than the lows of the year. We are clearly going sideways on all the major indexes. Eventually, it will break one way or the other. The VIX broke down this week. We're getting down to a level of complacency, and the dollar is breaking down. So that's on the daily charts. And on the weekly charts, it just gives you, I think, even a better sense, because the yearly charts going back to 2018, 2017, you could see the nice uptrend we had. For whatever reason, I don't have as much data on the Dow, so it doesn't look as clean as the others. And you could see how clearly the Russell is different than the other indexes. Looking at some of the things underneath the market, rates stabilized off the lows and the yield curve widened. You could see both the 10-year and the 30-year were off the lows, and on the week we were pointing north or higher. If we look at the yield curve, it's hard to see here, but it's widened significantly over the last several weeks. You're not hearing about the flattening and inverting yield curve every day on the radio. The AD lines also turned higher in white. I've got the spiders just to show you the markets there. And if I look at the NYSE AD, you can see how it's turned up. And interestingly, it looks like the Dow futures, the Dow Diamond ETF actually was the weaker of the major ETFs this week. This blue thing here is bonds. No surprise that it turned down as well. Breadth, number of stocks percent above the 200-day and above the 40-day are both in the middle of the range, certainly not giving a signal. 3-month new high low, which is a much shorter term indicator of breadth. Really, again, not giving a signal, turned down just a tad last week. You can see yellow last week, green this week. And you could see it's not at the extremes when you get signals. Daily McClellan, weekly McClellan, not showing any clear-cut divergences. We're not at highs or lows, so I don't really see a signal there. Within EdgeRater, I can run a number of scans. This one I call bucketology, and it tells me within the S&P 1500, which is what I'm looking at on the right-hand side, how many are below or above the midline of their Bollinger Bands. And you can see here, it's a bullish picture with 66% below their Bollinger Band, above the Bollinger Band, only 34% below. And you can see the histogram of the spread among the various deciles, with just a few stocks below the Bollinger Band and now about 9% above. And there's no signal on this. It's not an extended market. It's not beaten up that it's going to rebound. It's a neutral to bullish market. People know that I like the Hindenburg Omen. Why do I like it? Because despite the fact you get some spurious signals, when I get a clump of them, the market turns down almost every time. And I've talked about it in greater detail. There's no signals today, so I'm not going to talk any more about it. Market tone, this is the Woody indicator in deference to the respect of Ian Woodward. I'm looking at this where my arrowhead is, and you can see mostly green. So the market tone has certainly turned a little bit more bullish. If I look at the sectors, they're either green or yellow, so the sectors lean bullish. So despite the fact the market's going sideways, there are some things here that might make a bull more optimistic. Canaries in the coal mine, putting together some of the big names. Maybe I should redo this and kick some out. Basically sideways like the market. And as you could see in my comment, pretty much pulled back to support. Now, interesting week. We've got some Fed speakers this week. As you could see identified here, John Williams on Thursday, Michelle Bowman on Monday, Robert Kaplan on Tuesday. We've got some baseline economic events, the economic existing home sales on Tuesday, petroleum on Wednesday, jobless on Thursday with some PMI flash, new home sales. I would say that's a medium news week. Next week we'll have the monthly unemployment report, so much bigger. But look at the earnings on the right. Everybody probably owns something on this sheet, especially when you have such widely traded stocks as Amazon, Visa, Intel on Thursday afternoon, Illumina, and others. So I think clearly a big earnings week coming up. Now, I would take heed of what my statement in the lower right-hand corner, which says it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. I just reset that. Hopefully I still have internet access. We'll find out in a second. Yep, looks like we do. So my thoughts about the market. Markets continue to chop beneath the highs. Interest-paying stocks stand out on my top-down review. REITs and utilities. Not defensive stocks, but defense industry stocks really looked weak. And if this market does not go higher quickly, I think you're going to see some shorting opportunities there. I think I've got too much going on this internet, so I'll worry about TradeStation in a second. We'll try that again. Other thoughts that I had was the Brexit vote that was probably not in the bull's favor may impact the market this week. Also, the earnings clearly will be the most important, and I continue to remain building cash reserves and managing the remaining positions while waiting for the market to break out or break down. So let's go see what's working here with my internet not being happy. Some hotels have much better internet than they do here. All right, let's take a quick look at my TradeStation's working. I like looking at one thing here and then we'll move on. To get a sense of what the market's doing, I pretty much look at the same 6 things each time. And we just look at those very quickly. It will stay connected. If not, I'll go somewhere else. So let's start with the E-minis. We give it a second till we hit pause. Well, we're going to scrub TradeStation tonight. It looks like my internet access isn't working to get me connected, so let's just go into HGSI. So very quickly, since I can't look at the indexes deeply on TradeStation, let's just do a very quick review of some of the things that I like to look at within this program. So Major Markets Plus will give me 25 different things. These are a number of ETFs of the markets, and I'm going to go into top-down analysis, which ranks them by price and volume, related issues over the last 1 day, 5 days, and 3 weeks. Utilities, mid-caps, transports, treasury on top, industrials, dollar, treasury, the TLT on the bottom. So kind of a schizophrenic market, frankly. Let's look at the S&P 500. You could see here it was down 1.4. It's 1.4% off the 52-week high. It was down 0.5% on Friday, but up 0.5% on the week. I'm going to open up 2 windows. We'll make the one on the left a daily window. The one on the right, I'm going to make a weekly window. For those who've not been here before, there's a lot of indicators that are sort of unique to a community of people that I participate in within this product. And green is bullish, bull is bullish, red is bearish. If you're new to me and want to learn what all these indicators are, if you email me at hgsidoc@gmail.com, I prepared a couple of videos. So it's going to be a quick analysis of the markets. We're sideways. We've got all-time highs up at about this level. We are just below those highs. We've been sort of in a range-bound area, and until we break above or below that range, I think I'm neutral on the S&P 500. If I look at the Dow Jones Industrials, for example, you can see for the week it was down 0.2% and down nearly 1% on Friday. So here we go again, a similar range-bound sideways market. This is a new sell signal that came in on Friday. If I look at the NASDAQ composite, the NASDAQ was down 0.8%, although it was up on the week. Again, sideways looking market. And then lastly, the Russell 2000 using the IWM. Same thing, except much lower in the pattern, sitting right above major support here, which it's been oscillating above and below. So you got sideways markets going back. Frankly, we had a trend up until the middle of February, and we've been sideways ever since. So these markets are chopping, not at the bottom, chopping at the top. So there's got to be just huge resistance to break out above this. If I want to look at some of the other things that I care about, I think we already saw that the dollar was weak, and you could see that on the cash index of the UPP ETF, that the dollar has broken down considerably on the daily and on the weekly, pulling into this blue bar, which I think is the 40-week moving average. It can't be because that would be the 200-day moving average. So let me just open this up to review. It is the 21-week moving average, I'm sorry. The 40-week is the red, which is further down here. So a pretty deep pullback in the dollar. You would think that if the dollar's that weak, that gold must be strong. It was up 1/3%. Gold didn't move this much this week. Much of this rally in gold was due to the concern about the overall markets, the tariffs, trade wars, and other entropy. And despite a weak dollar, the gold was pretty flat on the week. The other thing they might look at here is silver. Similar pattern, you can see peaked back in the early September and has sold off since. And then the volatility index, VIX, as we already talked about, has come down quite a bit. Just for a newbie, every indicator here to me is just so I can look at the right edge of the chart and get a good sense of what's going on in the market. The top thing here, which is sort of buried, those are the Hindenburg omens. And why does the Hindenburg omen mean something to me? If I go back, for example, I look at the S&P 500. And let's go back to, let's look at the big pullback in the market we had at the end of 2018. Let's see if I can make this work the right way. Let's see. because there were a bunch of Hindis occurring in the market. Let me see. Major markets. Let me make sure I got it set up right. All right, so you can notice that as the market was rolling over in August of 2019, we had a number of Hindenburg Omen signs, giving sense that the market was in trouble. And I will point out that we had these occurring not after it fell down, but on the second day the market dropped. If I go back to earlier in the year or last year, see, we had some Hindenburgs. Still not there. What I wanted to go back to was 2007. So let me just accelerate it there. You notice you don't see a lot of Hindenburgs on the top, especially as we recovered from some big lows. But here we go. In June of 2007, the Hindenburg Omen started firing as the market was hitting new highs and continued to fire as the market sold off. Now, the market came back up for a retest, and if you might have thought it was all clear, the Hindenburg started firing again, and those Hindenburgs saved a lot of people I know by getting them out of the market before we had the subsequent major decline. So I like the Hindenburg Omen. Not everybody follows it. It's a little bit of voodoo, and only 1 out of 4 times is it correct. But there hasn't been a major market sell-off without a prior Hindenburg Omen for over 50 years. So I think it's important. We don't have one now. You only see it at market highs. So market sideways. Next thing I look at is number 7, which is the industries. And I look at 2-day force up. I've got 40 industry groups showing positive momentum. If I look at the 2-day force down, I have 35 showing momentum to the downside. And when you look at this, software, biotech, internet, e-commerce, semiconductors, IT, consumer electronics, and so on and so forth. As I look at that, those are what I usually consider high growth stock industry groups. So clearly, growth stock investing is under pressure. If I look at a 5-day down, give a little bit longer term view, only 30 groups have a little bit longer downturn. And if I look at a 5-day up, 55 groups are up on a 5-day window. So maybe this is just a short-term pullback on a longer uptrend move. Again, this market will resolve eventually. I would not rule out a resolution to the upside. Now, one of the strengths of HGSI, and let me change this, that's my view, open up my fundamental view, is if I right-click on precious metals here and go to change the industry group, it ranks the components of the industry group by positive momentum. So let's just take a quick look at the stocks here and see if anything looks interesting. You know, this is a chandelier stop here. These red dots are a Wilder PSAR. From the top, I showed you the Hindenburg Omen. The next two are a long-term trending indicator I developed with others called the Bongo. I'm not going to talk about it today. Then you have accumulation distribution. You have a 13 and a 2-day force. Then you have a new indicator I'm playing with that will be, the right name will be put on it soon. That was positive. This green line is the high jump. When it gets to the top, usually the market's extended and we're going to see it come back. The yellow is the squeeze. You don't see it on this stock, but above the squeeze is a set that is tied to Bible gap ups. These red and green below the squeeze are mobile breakouts and breakdowns from David Elliott. For averages, I use an 8-day exponential in magenta and a 17-day simple, 50-day simple, and 200-day in red. One of the cool things about HGSI is that this gray line here is the group strength, which I could overlay on a price bar. You can create any indicators you want, as many indicators as you want. Sort of, it's user choice. Over here, I know that within this industry group, 76% of the stocks are on a buy. And there are 4 new buys on Friday. So maybe gold is going to turn around. I do have some nugget because of that in my portfolio. I don't see it yet with Newmont, Barrick, Wheaton, AEM. This is probably the strongest performer. SBGL continues to break out despite gold pulling back. Cheap stock, so it's a small gold play. So that's something that I might be nibbling at or looking at. AU sitting right at free parking on the 50 in a squeeze, so that might be something you might be looking for as well. So there's some interest in gold. The big guys in the beginning, Royal Gold included, don't look so hot, but gold stirring. Again, with the weak dollar, certainly I don't find that to be a surprise by any means. If I right-click on REITs, REITs looked great. And in fact, of the first 5 stocks, 4 of them, were considered for my buy list. So let's take a look what we got here. First one is Crown Castle International. This, I believe, is one of the companies that does cell towers, wireless infrastructure. It's broke back above its moving averages. You can see the industry group coming out of a mobile breakout from a squeeze. Pocket pivots and kahunas, pays a 3% dividend, great earnings per share growth. I think this is interesting, as I think American Tower Corp, AMT, sitting right on free parking in a squeeze with a number of momentum indicators, we call impulse indicators, turning positive on Friday as well, 1.6% dividend. For those that like dividends, Iron Mountain Paper Storage Company breaking above the 200. This has been in a downtrend for quite some time. It's coming out of a squeeze. Pocket pivots and kahunas. I also like WP Carey. What a beautiful lower left, upper right, really tight. Mobile breakout from a squeeze, pocket pivots and kahunas. 4.4% dividend looks excellent as well. Clearly in a stage 2 growth phase, something that we talked a lot about at the Minervini conference. So there's a lot to like on these. And as I said, I saw a number of interesting REITs on my top-down review. Banks, regional banks looked great on Friday as far as the indexes went. And this is typical. They've been beaten down. Here's one breaking above the 200-day moving average. Certainly not a picture of health and growth, but maybe something's happening as it breaks above the 200. Western Alliance has broken above as well. Pocket pivots, kahunas, everything's green. Also had a Morales and Catcher Bible gap up, 0.5% dividend. Growth rates is high or higher than the PE, which I like to see. Regions Financial Bank. So again, do you see rate, lower left, upper right patterns? Do you see pullbacks, breakouts? No. But you see stocks that certainly are firming up. And this clearly is related to firming up of interest rates and bonds coming down. Generic pharma, I think some of this related to some legal settlements. Hard to see Teva as a great growth stock. I don't buy things this far below the 200-day moving average unless there's some inertia or momentum. Now I could just do a right click, more info from the web, and FinViz, and open up my browser, and it should open directly to Teva. And is there news? Knowing the situation, I wonder if there's an opiate lawsuit. Settling opiate suits probably won't end the crisis. Drug suppliers. Teva breaks out amid hopes of opiate settlement. Not a growth stock story, and let's move on. The other one there was Allergan, and a little bit better looking picture. This is a stock that was very beat up. If one takes a look at the weekly chart, you can see this was a stock that was at the $300. Now it's been knocked in half over the last couple of years. I know they're trying hard to turn it around. Certainly gone sideways for quite some time and now moving up. I look at the growth rate on earnings. I'm not impressed. And this is a company that's also laden with debt. Next on the list is the index, so I don't usually go below the index. So on a typical top-down review, I'll look at all the top 10 groups, take a look at the various constituents, and I'll start to build a watch list of stocks that I'm interested in. Here's Lennar, beautiful. This is when I talk about my trades I like to take. A stock that's in a downtrend, it breaks above the 50, goes back to the 50 and holds and moves up. That's a buy point for me. Now, I had a squeeze here, a number of my signals firing. That would have been an interesting time. And then you could look at each time it pulls back to what we call free parking, the 50-day moving average, or in the case of strong leaders, the 17-day moving average, always giving an opportunity. We're extended here. You can see the high jumps up at the top, so I wouldn't be chasing Lennar, but it's certainly doing well. Less extended, but also after a big run is DH Horton. I wouldn't necessarily be selling it, but it's hard for me to buy stocks when this green line here is at the top. This was a beautiful breakout this week. Tri Point Homes, it's in the right industry group. It's not about its earnings per share growth. A bunch of pocket pivots and a kahuna. For those that don't know what kahuna is, it's just a profound move within the Bollinger Bands. I think it's 40% of the Bollinger Bandwidth move in one day. So a lot of interesting things in the home builders. Most of them have run quite some bit. Electrical power equipment. Look at Generac. That was a topic at dinner. Sideways player here in Eaton, so I have no interest. I'm looking for growth that pulls back and has momentum. So the time I want to buy a stock is right here. How do I know that? Because a kahuna had a big move. It had a pocket pivot, and my other indicator turned positive. It's pulled back close to the 50-day moving average here. It had a mobile breakout and a Bible gap up. I think Generac looks interesting. It's not about the fundamentals. If you look at the fundamentals, there's very little growth. PE of 17.61. So Generac is something that I do think looks good, but it certainly gets hyped up every time you have a hurricane hitting Florida or these discussions about cutting off power in California. Midstream oil and gas, I mean, it's not as if oil prices are high, so why are these hitting the list? Well, one, the stock they have huge volume, 11 million shares average volume. And on Friday, they had the average 11.5. They're also hitting it because they have fairly significant price moves. Here it was only 1.43%, but the 11.5 million shares, that makes for a compelling element of force. This pays a 9.6% dividend. I own some of this for the dividend. I bought some this week. It's not a stock that's a growth stock. To me, it's a bond equivalent. And right now, that's a pretty nice dividend if they can actually meet it. This one looks better. This is Enbridge. It's broken above its 200-day moving average, pays a 6% dividend. So the theme here with the REITs, with these, and with the banks, it's tied to the interest rates firming up. Holly Energy, again, a big reversal here, but this is so far down in the pattern, except if you want 11.6% dividend and hope that it's reversed. I don't know how or why I could buy that stock. Plains All American. So that's, are you seeing great growth stocks on my top-down review that you want to go out and buy? I didn't think so. I'm not either, but I'll show you before we get done, I promise. Next, Terra Energy. A number of utilities look like this. Beautiful lower left, upper right, and tight. You want to buy this when it pulled back, and as Minervini says, tightens up. Well, you got a mobile breakout from a squeeze, 2% dividend. It's just not the type of stock that I usually start trading. Exelon, no. American Electrical Power looks very similar to the first one. Nice lower left, upper right, tight pattern coming off the moving averages, mobile breakout from a squeeze. A Gil Morales pocket pivot and a kahuna. That looks very interesting as well. Again, I don't usually buy a lot of utilities. I'm much more interested in growth, and I like to buy growth at a discount on pullbacks. Containers and packaging, certainly not a high growth index or group. This is one, Crown Cork and Seal. No earnings per share growth, modest multiple. Here, HGSI is so wonderful. It's given me, not compared to the prior quarter, but compared to the prior year's same quarter. So you can see a number of quarters of growth, stubbed their toes in June, continued to have weakening, but I guess this is a defensive play, and it had a big move this week. Again, not a group that I'm usually chasing. I can find good stocks. Sometimes it doesn't matter what group they're in. I typically go through the top 10 groups. Let's see if there's anything renewable energy. Take a look at Ballard Power. So Ballard Power, that's a breakout on Friday. Fundamentals don't look so hot, but you have a kahuna and a breakout. And considering that the next earnings are not to March, it's probably broke out on earnings. And again, left click, right click, then a left click here. FinViz tells me the reason for it to be up is, oh, they just announced a conference call. That's interesting. Let's see if there's anything else. Oh, I guess, because it got included in an index. Well, that's certainly not the greatest of reasons to be buying a stock in my mind, because typically after the initial bump, it pulls back. Solar Edge is one that I've been a fan of. Its last earnings, it actually had good earnings and beat estimates. It's sitting right down at the 50-day free parking. I won't buy it without seeing some momentum, but a break above that point there, I'd certainly want to be in, maybe even earlier if it shows some momentum. So I'd put Solar Edge on a watch list. SunPower is too far low. All right, so I typically every night will do what I just did, looking at the top 10 groups. I wanted to see if I have, where I saw some very interesting stuff, was actually in waste. And I'm surprised that it didn't make my 2-day list up. I saw a couple things to the upside and downside that I want to point out where I think there's an opportunity. Let me check TradeStation again. Hold on one moment. TradeStation is not cooperating, so let me just do it here. I went through an exhaustive bottoms-up review, as I always do on Saturday. Looked at about 700 stocks. I came out with a list of stocks that I'm interested in buying potentially, and a list of potentially selling. These will get put into a watch list within TradeStation, a radar screen, where I'll have the ability in that radar screen to monitor them for bullish or bearish signals, and I'll show you by working up one of the stocks how I typically trade them. So here's my buy watch for this week. Let me hit warehouse view and take it out of this. Here are the 41 stocks that interested me. If I go by industry, it should be pretty clear where I'm going to be looking. REITs, dividend payer; refiner, dividend payer; telecom carriers, dividend payer; and waste management. Not all traditional growth stock entities. Perhaps my favorite group, and when I say group, when I see 4 stocks in the same industry group, I kind of get excited. This is Clean Harbors. So are we in an uptrend? We're certainly in an uptrend. Down here, we were at about 63. We closed here closer to 79, and that's over a 4-month period of time. We have consolidated. We are in a squeeze. We had a Mowbray breakout, pocket pivots and kahunas, a weekly doji reversal, very bullish signal. I've got earnings per share growth, modest, elevated PE compared to earnings, and then 300,000 shares, so not very active. But this is a stock that I could buy right now. Not the one I'm going to work up, though. Republic Services. Here we have an early buy breaking above the moving averages. You can see here the group strength coming out of a squeeze with a mobile breakout, pocket pivot and kahuna. Very buyable right now. You can see in this group, 92% of stocks are in a buy. 2 signals on Friday were both new buys. How about Waste Connections? Perhaps I like this one the most, not because of its earnings per share growth, but because it's actually starting to move off of the indexes, coming out of a squeeze now with momentum. Here you go, uptrend, pullback, breakout. This is the trade I take day in, day out. So we'll come back to Waste Connections, maybe. And then Waste Management, not quite yet. I'd like to see it clear the PSAR, but setting up as well. On the REITs, we looked at most of them already. I also very much like AMT, but it looked like Crown Castle might be moving already here. So these are two stocks that I will be thinking highly of as we go into the week, but I don't make my trade decisions until I see what the market does. Right now, healthcare is risky because of all the discussions in Washington. I talked about AbbVie over the last month. I continue to like AbbVie, and AbbVie to me always feels like a pharma from a dividend perspective, paying a 5.6% dividend, but it's a biotech stock with in reality, with a very active pipeline. So I'm a big fan of AbbVie, and I currently own AbbVie. Copart is another stock that looks very good. Again, you'll see the same thing with me, time in and time out. Uptrend, sideways, breakout. Mobile breakout from a squeeze, my signal, pocket pivot, and kahuna in a very strong group. So these are the list of stocks that I like to the long side. And when it came to the short side, I was shocked at how bad defense stocks look like. And let's take a look at my shorting candidates. And again, just to reiterate, especially for those who have not been here before, just because I have a stock on a buy list or a short list doesn't mean I'm shorting them on Monday. It means I'm creating a watch list that go into my scanners, and then I take action based upon changes in the marketplace. So, for example, take a look at Lockheed Martin. Here you have a stock in a significant uptrend, which is now broken down below the 50-day moving average with the 8 and the 17 crossing below. You see the falling group strength. You see a mobile breakdown from a squeeze, pocket pivots to the downside, and a kahuna to the downside. And on the weekly chart, breaking down as well. And I'm not going to go into it, but this blue line is a comparison of the red line is the comparison of the stock to the S&P 500 from a relative strength. The blue line is a moving average, and when it crosses below the blue line in the setting of a breakdown, to me, that's a pretty good signal. Now, the safe bet would be wait for it to take out the chandelier stop on the weekly. It already took out the chandelier stop on the daily. This one looks ready today to short or buy puts on, but I wouldn't execute anything until I broke below the close of the day. Now, keeping with the family affair like we saw in the waste management stocks, if we look at Northrop Grumman, very similar pattern. Looks like I didn't even change the chart, doesn't it? What if I look at L3 Harris? Same chart again, and your targets have got to be down at the 200-day moving average. Spirit Aerosystems, they're both defense, and they have a lot to do with Boeing and some of their airframes and breaking down as well. So serious breakdowns here, and they look very shortable. They look shortable right here. But again, I have to see what the market does. A stock that I've loved on the way up, but really looks weak on the way now is ServiceNow, breaking down below the 200-day moving average. And you could see that this break below its moving average was sort of told you something, and it's failed 1, 2, 3 times. ServiceNow looks to me like it's going lower. There is nothing below this stock because you're taking this support out. I could see this pulling all the way back to the 180 range. So this looks interesting. And then a stock that every time I say to short, I end up going long because it reverses. But Shopify failed here at the 50-day moving average. And to me, that's a very bearish signal. And it looks to me like Shopify might be tempted to go down to the 200. I say that, but will also tell you this has just been a monster stock, as you can see on the left-hand side. So I've got a list of stocks Now, I like to work up how I'm going to do a trade. So let's go back to the buys, and I've got a few minutes here. I'm not at home, so I could take as long as I want. And let's work up WCN. So let me get a pen and a piece of paper and show you how I do it. So I'm going to open up the price window here, and it's going to tell me a lot about my stock. It's going to tell me that the close was at 94.20. Now, I prefer when I take a stock like this that I'm going to buy it if it takes out a buy stop, and I typically will set the buy stop higher than the current price. So if I was to buy it, I wouldn't buy it until it cleared 94.20. So say 94.30 would be my buy. Okay. Now for a stop, let's look at the low of the day here, 92.21, 91.45, 90.47. So 90.47 is the lowest bar in 4 days. And at this point, the 50 is at 91.71. So 90, let's say 90.40 would be where I would potentially sell it. Now, I look at that, which means I'm risking $3.90 per share on a 90 plus stock. So that's basically, I'm risking 4%. That's totally within my risk tolerance. So, and if for every $1,000 I was willing to lose on this, I could probably buy, well, I can tell you exactly, I'll take $1,000 of risk and divide it by $3.90. So I could buy 250 shares per $1,000 of risk. So if I was willing to risk, say, $5,000 per trade, which is pretty typical, then I would be looking potentially at buying 1,250 shares with a buy stop at 94.30 and a sell stop once the trade is activated at $90.40. So that's the basic parameters, but that's not what I would do. Let me show you what I would do. I have a lot of toys. All right, let me update this. I'll put you pause while I update it. All right. This program is called Dynamic Profile. When it's purchased through VectorVest, it's called Options Pro. The stock we were looking at is WCN. I gave you a buy stop at 94.30, a sell stop at 90.40 once the trade is entered. Since this market is skittish at best, I would take half off at a 98.20, which would be about the recent high, and then I'd let the other half run. I might also look at options. So let's look at some of the opportunities here. So let me get the right product open. Let's open up my spread tool. And let's say I'm interested in options on WCN and I'm bullish. So I'm looking at long stock, long call, short put, bull call, synthetic. These are some of the bullish options. I'm going to look at starting strike price at the money, which would be $95. I'd be interested in a minimum range of $5 is fine. And what do I got here? So these are the different bullish trades that I think I selected. There should be 5. And I'm going to look at each one and talk about the pros and cons of that trade. Start with a long stock. As we talked about before, I know that if I bought stock here, that I would have a limit to how much stock I could buy based upon the risk per share, which was $3.90, and what my risk capital is. Here's the price today. As the price gets higher, you could see you're profitable on the stock. If the stock price drops, you lose money. To buy 100 shares, it's going to cost me $9,420. My potential profits are infinite. I like that. But my risk is I could lose it all. And buying stock is certainly reasonable. I don't want to tie up that much money. So maybe I'm just going to buy a call. The benefits of buying the call are my out-of-pocket is $157 to control 100 shares. My potential profits are infinite. There's a couple of problems with buying a long call. I'm going to show you those. You notice that the risk curve here looks different than the stock price. So a couple of things. The good news is all that I could lose on the long call is that $157 I paid to buy the call. So my losses, unlike the stock, which are infinite, are capped. Also, like the stock, on my long call, I have infinite potential for profits. You'll notice that the P&L line in blue is shifted to the right because I had to pay money for the right. So I actually have to see the stock move that $1.57 before I'm break even on this. So unlike owning the stock where I'm profitable on the first dollar above, there is a cost of that call that I have to make up before I'm profitable. Nothing wrong with this. On some of the glamour stocks, the premiums are ridiculous because they can be, but I have no issue with a long call. What about selling a put? I think the stock's going up. I feel very comfortable with that, and I don't want to spend any money. So if I sell a put, I give a third party the right, but not the obligation, to sell me the stock at the strike price of $95. Now that means, just like owning the stock, I have responsible for it no matter what the price is. So I have potential for losing the entire $9,400 minus the money I put in my pocket, the $2.45. So in the case of 100 shares, that would be $245 that I would get in premium. So the short put, I carry the downside risk just like owning the stock. I've capped my gains at the amount of premium I get for selling the put. And even if the price goes down a little bit, I'm still profitable because I have that premium up front. Now, some of the richest people in the world sell puts all day long because puts often, maybe most often for them, expire worthless, and therefore they get to keep the money in their pocket. The downside is if you see a market collapse and the next thing you know, you end up buying the stock at a much lower price, but you have to pay them the $95, which is the strike price. Nothing wrong with that. A bull call spread, that's another interesting trade. In a bull call spread, I'm going to combine a call, buying a call, with selling a call at a higher strike price. So when I bought the call, I had to pay $1.57. But by selling a $100 call, which is above my initial target, I lower my price from $1.57 to $1.35. That's not real attractive to me, and I probably wouldn't take that trade. But you'll notice with the call spread, it's less money to get in, so it has to move less for me to be profitable. I've capped my gain, I've capped my loss, so it's a relatively safe trade, and it's a little bit less expensive. I'm not going to do that trade either. Let me show you the trade, one of two trades I'm going to consider. Probably the trade I would take. Now, I'm going to manage the trade the same way. I'm not going to put the trade out there unless I get above 94.29, and I'm going to close my trade if I drop below my stop. I love synthetic stock. Let me show you why I love synthetic stock. What can you tell me about the P&L curve, this blue line with the green area profitability and the red area a loss? And how does owning a synthetic stock compare with owning the stock itself? You have the exact same P&L, where I'd have to pay $94.20 to buy 100 shares of stock. I actually get to put $87.50 in my pocket for every one of the contracts I do on the synthetic stock. The beauty of this position is it's cheap to get in. I capture all the gains as I would by owning the stock. The downside is I have the same loss as if I own the stock, which is substantial and significant. So I would take one of two trades, and a lot of it depends on the market. This is not a market to be a hero. So the trade I'm going to take on this is I'm going to take, let me do this again. I'm going to take this spread and I'm going to say, how can I reduce my risk and not give up my upside? So I'm going to go into edit spread and I'm going to buy one put at the same date, and I'm going to look at it and go down to where my stop is, 90. So now here's what's going to happen. Now, you tell me if this isn't a beautiful trade. I'm still going to get paid a credit. I'm going to get paid $12.50 per contract, controlling 100 shares. I like that. I have capped my loss at $487.50 per 100 shares. Okay? I can't get below my stop, at least if I hold this to closure. So I have a trade that allows me to maintain 100% of the gain, has controlled risk, will take minimum margin requirement because I protected the bottom, and to me is the trade I make. Now, I can't find this trade with any special name. I used to call it the Jeffrey Scott chicken shit synthetic because I was chicken and taking care of myself on protecting me with that bottom put. But it's really a combination of a long call and a bull put spread. The bull put spread creates a credit, which ultimately pays for the call. Now, here to me is the piece de resistance. What I've really created here is a synthetic call. And I am willing to assume a little bit bigger risk, and I don't have, instead of having to pay money up front. So in summary, I look at each stock this way, whether it's short or long. I compare the benefits of buying stock versus a series of different options. And I love this synthetic stock with a put protection, and that's what I'm going to do And don't you love it? I'm actually going to get paid to take that trade. Now, I will put in a order. I will probably put the order asking for a little bit bigger credit so it doesn't fill at the minute the market opens. I will set a parameter that the stock has to trade above, at or above 94.30, and then I can adjust the parameters once the market opens. So that's the trade I'm going to take. Not going to spend the time. I do the same thing on the short position as well. So for those that I met this weekend at the Minute Reading meeting, I hope you didn't get scared off by all the funny names I use. If you have questions about what they are, email me at hgsidoc@gmail.com, and I'll send you a link to download a video that goes over some of the power of HGSI and then what these indicators are. They're just derivatives of price and volume, and they allow me to quickly look at something to see what I think. You guys have a great night, and hopefully this will get uploaded sometimes on Sunday. And again, I did this in 4K, which I've not done before, so it'll be a big download. And we'll see how it looks on YouTube. Don't be afraid to download it from my Dropbox if it doesn't look good on YouTube. Thanks, everybody. Good night.